Clearly, it has been a pretty tough time to be invested in the stock market, which also in theory makes it a tough time to be in the public markets. What are you seeing in terms of activity and companies' desire to become public in this kind of environment?
Well, first of all, it's great to be here, so thank you very much, Kaylee. Well, it has been an interesting start to 2022 in terms of the IPO market. We had such an amazing market last year in terms of companies coming out into the public markets. We had over 750 IPOs last year. This year, we started off much slower. We had 70 IPOs in the first quarter, and when we look at how the second quarter is evolving, I would say that companies are still staying on the sidelines as opposed to tapping the public market. And you have to understand what are all the ingredients that are driving that. I think, first of all, the underpinning of the U.S. economy continues to show strength. However, there are a lot of uncertainties out there for investors. And the one thing investors really like to be able to do is predict the future. And that gives them confidence to make a risk decision to invest in a new company that's coming out into the public markets. It's very difficult to predict the future when you don't quite understand exactly how monetary policy is going to evolve. Right. You have really interesting geopolitical backdrop. And you have a labor environment, an inflationary environment that creates challenges as well. And so I think that's holding investors back from being able to make conviction buying decisions, which then, of course, holds companies back from coming to the public markets. The pipeline of companies that want to come out into the public markets continues to be quite strong. I think we have over 250, I think it is, filings, S1 filings that are looking to tap Nasdaq in the coming months and quarters. But they're going to come out when the investors are ready to be able to take those risk decisions and be investors in their companies.
So, Adena, good morning. Is it going to be a 2022 story for them, or do you think it's going to be a 2023 story for them? What will this year's number look like compared with last year's number?
Yeah, I think it's actually really difficult to know the answer to that question, Guy, but I know that there are some companies that are hoping to be able to tap the public markets this quarter. It's likely, though, that if the markets continue to be volatile and create a lot of uncertainty, that they might wait until later in the year. But I would expect that, I honestly don't know the answer to that question, but I would expect that there are companies that if the environment becomes more certain, if monetary policy becomes more obvious and certain, and we get into a mode of understanding the next moves by the Fed, I think if we also see the labor market stabilize a bit, we see inflation start to tame a bit, I think that you could see companies starting to come out in the second half of the year. But it really is going to be market dependent.
And what kind of companies are we talking about in this pipeline? What industries in particular do you expect to see the most activity eventually?
Well, I mean, first of all, Nasdaq is the home to companies from every sector, but the companies that have been really eager to tap the public markets are those that are really leaning into the digitization of the economy, those that are leaning into, maybe providing new technologies to help get to a net zero environment. These types of innovators that we see coming to Nasdaq every year. I think that those are the same kind of companies that are looking to tap the public markets. They're, whether they're healthcare and biotech companies, technology companies, what I would call new energy companies. I think those are all areas that we see, strong interest.
Adena, I'm going to ask this question before Kaylee does. I'm going to get in there first. Nasdaq and crypto, are they going to go hand in hand? Where do you fit in?
Sure. Well, Nasdaq today is actually a scaled technology company that serves the broader capital markets and the broader financial system. So we, in fact, have a big role to play in facilitating and helping crypto markets as well as banks and brokers manage new digital assets. So we provide our technology to 130 other markets around the world, including, actually, I think we're up to potentially 10 crypto markets now that are leveraging our technology for trading, for surveillance, and for other means that they have to make sure that they can grow and expand their business. We also have a very scaled anti-financial crime technology solution where we've created a new module specific to digital markets to make it so that banks can evaluate AML risk as well as fraud risk in their digital wallets as well as in their more traditional accounts. So we have, and we also, one third thing is we have a crypto index that we've launched outside the United States, index products we've launched outside the United States. So we have a role to play there, but as a market operator, operator. I think that we're still trying to understand the regulatory landscape as well as the overall maturing of it for the institutional use of crypto before we make bigger decisions as a market operator.
Yeah, Adena, the reason Guy joked about stealing that question from me is because I do host a show, Bloomberg Crypto, once a week here on Bloomberg. Would love to get you on to talk about that further. But something else we have been talking about on that show a lot, in addition to regulation, is just the security issues around it, the role that cryptocurrencies may or may not play in evading sanctions, for example, given the war in Ukraine. From your standpoint, I'm wondering how you view some of these risks around Russia in particular and cybersecurity. Where does that rank on your list of concerns?
Well, I would say certainly cyber risks is really a risk that's universal to the financial system and certainly to the capital markets. And that's something that we take extremely seriously. We work very collaboratively with other industry players, with the governments where we operate, to make sure that we understand what's happening in the space and we're protecting our markets and protecting our technology to the best of our ability. I think that with regard to other risks, as you mentioned, sanction screening and other concerns that they have, particularly as they're using new ways to facilitate commerce like crypto, I think that that's an area where the technology needs to continue to be brought into the financial system to help with that. And actually, that's a big reason why we bought Verafin, which is a scaled anti-financial crime technology company. It's very modern. It's a cloud-first and cloud-native solution. It has, therefore, the ability to be much more advanced in helping banks protect themselves against the sanctions violations. And we actually have a new sanction screening module that we're rolling out right now to our clients, in addition to, of course, offering more advanced solutions for digital assets and digital wallets.
Let's talk more about regulation, but come at it from the SEC's point of view, Adena. The SEC is putting out a bunch of proposals right now. It clearly wants to improve this market from an investor's point of view. What do you see the best ways of making this a more investor-friendly market? What do you think about payment for order flow? Should that be something like over here in Europe that should be banned in the United States? How does market structure need to change to make it more friendly for investors?
Yeah, one of the great things about my job, and I've been with Nasdaq for 26 of the last 29 years, so I started 29 years ago, it's actually one of my favorite topics is to talk about market structure because it's an eternal learning curve, and there's, perfection is impossible, but we all strive for perfection. And so as we look at today's markets and what's working well, I would start by saying I do think the markets have demonstrated really tremendous resiliency in a very volatile period of time. I think that the markets generally are working well in terms of creating fairness and creating an environment where every investor can express themselves with their strategies and the types of orders that they want to enter in. We give them instantaneous access to trades. It's a very fast market, and I think that we really try to reduce friction. But the fact of the matter is there's always improvements we can make. And so Nasdaq recently put out its own views. We actually have a paper out there that really talks about what needs to be done to strengthen what we call the national best bid and offer. And that's where orders really come together and there's transparency about the buying and selling interests at any given moment in the markets. The stronger the national best bid and offer is, meaning more confluence of orders coming together and reflecting themselves in a transparent way, the better price that investors are going to get when they put an order into a market. And that comes with leveling the playing field between the lit exchanges and the dark pools. And it does go into looking at the incentive structures, both in terms of whether it's broker incentives as well as exchange incentives, as well as also the tick sizes. One of the issues that we have today is there are a lot of companies that we call are tick constrained, meaning our markets can only express ourselves in pennies, but when you really look at the true supply and demand in that stock, it's happening in sub-pennies. And as a result, all of that order flow is going off exchange. So I think leveling the playing field on tick sizes as well is another key area. So we have a lot of proposals, and we're excited to talk about it whenever you want.
Well, and the SEC is also taking a bit of a hard look at SPACs in particular. I'm just wondering, moving forward, do you think companies will continue to take non-traditional ways to come to financial markets, or are we going to shift back to just straight up IPOs?
I actually think we have to look at it from the perspective of a corporate. They today have 3 different ways they can tap the public markets, and I think that's great, to give companies choice on how to come to the public markets. They can do a traditional IPO, they can have a direct listing, or they can go public through and being acquired through a SPAC.
Yeah.
I think the key that what the SEC is trying to do is just make sure that investors are protected in all three of those mechanisms. The proposals that they have out there are really designed to make sure that there's a balance between the sponsors of the SPACs and the investors in the SPACs and in the public companies on the back of the SPAC combination. That, it's an evolution, right?
Yeah.
It's like this big innovation came out.
Yep.
Now it's a matter of maturing it and making sure that there's a balance. And I think that's healthy. That's a healthy part of the capital markets.